All right, today we're going to talk about real estate as an investment versus the money market. Now, let me preface this with I'm not a financial advisor or an investment advisor. I think both are great investment tools. I think they both serve their own purpose. In a recent social media post, I saw someone talking about how investing $100 a month for 40 years now would turn into $1,176,000. Now, it didn't say in that post that, like, I worked it backwards, and I think you needed to have a 12% annual rate of return over the 40 years, compounded, obviously, in order to hit that number. And I think if you look at like the S&P over 40-year term, I think it's like maybe a 10% return over 40 years, 8 to 10, I think, which changes it drastically because that number then becomes 349,000 versus 1.176. So like it triples for that extra 4%. But anyways, that's not really the point here. And we're going to get into all of that on this episode. My name is Anthony Malfera. If you're new to the channel, I'm a Toronto real estate broker working across the GTA and, trying to help buyers, sellers, and investors make smarter, long-term, informed decisions. On this channel, we break down real estate, wealth building, and market strategy in a more practical way. No real hype, just the real numbers and the facts. If you find value in this video, hit like, subscribe, and turn on notifications so you don't miss the next breakdown. So let's get into this. So today's question, what actually builds more wealth over a 40-year timeline? Investing $100 a month into the stock market or using the same discipline and putting it into real estate? And then more importantly, like what happens when we include inflation, mortgage shortfalls, negative cash flow, long-term payoffs? Because again, you can't do it exactly the same way, because if you're investing, you can't really invest $100 a month in real estate unless you invested in a fund or an investment REIT or something of that sort. So there's going to be a little difference in that investment strategy, I guess, but we'll break it down in the two different scenarios, because I think a lot of people oversimplify this when they just look at an investment amount, a rate of return over a period of time. So let's look at the financial market in the first place, and let's look at a 7% real return, okay? Because we have to factor in inflation. So $100 a month over 40 years, a 7% real return, meaning again, inflation has already been factored out, okay? After 40 years, that becomes $262,000 in today's dollars, okay? You've contributed $48,000 total, and then the rest is compounded growth. Now, this is very passive, liquid, low operational stress, right? That's kind of like the benchmark. In scenario 2, which is the real estate scenario, which would factor in leverage, right? Because we are going to be borrowing a lot of the money that we're going to need to buy the property, right? So now let's structure this like more of a realistic long-term Toronto-style rental hold, okay? Let's assume $400,000 down for the property. So you can, and that's not totally unrealistic today. You can get a condo now, in that price range, depending where you're looking, okay? So that's $20,000 down at 5%. A 25-year amortization for the mortgage at 5% annual appreciation as a return. That's really, though, 2% when you factor in for inflation, right? Because there's 3% that goes towards inflation. And we're going to break the real estate into kind of a phase 1 and a phase 2, and you'll see why. So the first 25 years, right, you're most likely going to have some negative cash flow. And this is normally where people kind of quit. So let's assume you're short $300 per month, okay? And after rent, taxes, insurance, maintenance, vacancies, okay? So $300 a month times 12 times 25 years is $90,000 out of pocket. So your total investment over 25 years is about $110,000 when you factor in the original $20,000 deposit. That's the uncomfortable part, okay? But during that time, the tenant is paying down your mortgage, right? Inflation is eroding your debt, right? Because if you're borrowing again let's say you're borrowing $300,000 today, in 40 years, when you compare that debt to what the value of the property is, that debt has been eroded, okay? And the property is appreciating, right? So now phase 2 is going to look at years 26 to 40, right? Where you're pretty much mortgage free. Let's assume the property nets $2,000 per month in today's dollars, okay, over the remaining 15 years. So that's $2,000 times 12 times 15, which is $360,000 in real cash flow. And you still own the property. After the 40 years, the property's real value in today's dollars would be $888,000. Let's look at the kind of the final outcome from the real estate on the real estate side. And this is inflation adjusted. So the asset value is $888,000. The cash flow you collected over the last 15 years was $360,000. Okay. So your total real wealth generated is $1.25 million against the $110,000 that you invested over the 25 years. So now let's kind of figure this and look at this as a side-by-side comparison. So in real dollars again. So your stock is approximately $262,000, your financial investment. The real estate, which is leveraged and showing your realistic shortfall, is approximately $1.25 million. Now that's nearly 5x your investment. Okay. Now here's the important part and the honest part of it. Real estate wins. And again, when I did this, I want to say, when I did this scenario, I truly did not know what would win. Honestly, sometimes I'll think like maybe the financial market is better over time, and it can be depending on what you value. Okay, but I think real estate wins because of leverage, for one. Debt amortization, inflation is working in your favor, and time. Okay, but it does require, a risk tolerance. You got to manage tenants. You got to, you're going to go through downturns. You're going to survive those downturns because you're a bit more invested than you would be during the downturns in the financial market. It involves planning for liquidity, emotional discipline, right? Most investors don't fail because real estate doesn't work. They fail because they can't survive years, 3 to 7. Now, stocks, on the other hand, easier, more liquid, truly passive, much lower stress. And I think different personality profiles will thrive in each. The real wealth strategy, high net worth investors probably don't pick one. If we're being honest, they probably combine both, right? Stocks are a steady kind of like compounding engine, and real estate is a leveraged asset multiplier. And I think together they create stability and acceleration in both markets. So if you're building long-term wealth, the real question isn't like which is better. It's what can I hold, through volatility for 40 years, because time is really the real advantage, and leverage, when used responsibly, is what accelerates the investment. One more thing before I end this episode. When I was doing this, I was kind of like thinking about the value of that condo in 40 years. I'm like, well, it's $2.8 million. Like, doesn't that hedge us against inflation? And it does, but you got to remember, it's still appreciating at 5% a year, and inflation is still whatever, let's call it 3% a year. So it is, but it's not. The value of that $2.8 million condo in today's dollars in 40 years is $880,000 in terms of real purchasing power. Then it's like that now. It's like, so right now you could buy a condo for $888,000 here, and pretty much the average price of real estate is around $1 million. So in 40 years, that $2.8 million condo is still going to be around that average price for real estate then, right? So I even had to wrap my own head around that when I was thinking about this. So is it hedging against inflation? Yes. The property value rises with inflation, rents rise with inflation, and replacement costs rise with inflation. But here is the really important part. Your mortgage amount does not rise with inflation, right? So over those 40 years, inflation actually makes that debt feel smaller. Again, as you're paying it down too, right? So, so the asset inflates, rent inflates, debt stays fixed. The tenant pays it down, and that's kind of the hidden advantage, I think, on the real estate side. So if you found this breakdown helpful, hit like and subscribe. I try to post weekly content breaking down, like I said, real estate strategy, market updates, and long-term wealth planning. If you're in the Toronto area and want to talk through what this could look like for you personally, whether it's buying your first property, repositioning your portfolio, or just understanding the numbers, reach out directly. My contact info is below. Thanks for watching, and I'll see you on the next one.